I'm excited to introduce our guest for today, none other than market analyst or lead market analyst. Dylan, I forget what your title is. I'm so
Future
sorry,
person.
man.
It's something like
The
that, man.
all I know is truly one of the smartest people on Bitcoin Twitter, someone who I look to for a lot of understanding on how he's seeing and reading cloud world and how that pertains to just the global markets. Dylan, how are you doing, man?
Doing great. Excited to be back after a long weekend. Went to the U.S. Open, which was good fun. But back in the saddle and watching the global economy, slow, gradually then suddenly implode. And it's exciting times at the very least. Yeah, happy to be here.
If you're not familiar with Dylan and his work on Bitcoin Magazine Pro, please go over and subscribe to Bitcoin Magazine Pro now. We've spent some time discussing on Bitcoin Magazine Pro the ongoing energy debacle over in Europe, which I'm assuming, Dylan, is what you were alluding to when you're saying slow, gradually, and then suddenly the whole world is going to just collapse. Um, let's talk Europe. We were going to share a story out of the UK just before you joined us, and that is the new prime minister just hitting the ground running and is going to print 130 billion pounds in order to try and freeze UK power bills. We kind of know how this story works, but for those who maybe aren't as well versed, Dylan, do you mind walking us through when you hear or see something like that? How does that relate back now to what your expectations are with oil and gas prices in Europe, as well as what could happen with the pound?
Yeah, I mean, you've seen a kind of a geopolitical risk premium in energy prices, but specifically European energy prices since the Putin invasion, and honestly before that, as some people could kind of see supply constraints coming with forward European gas prices. But essentially, the entire eurozone is old. Demographics are terrible. They're up to their eyeballs in debt in relative terms, and they're kind of all constrained in this kind of European currency block where it's like you have a bunch of different sovereigns all under one monetary union. It's much harder from a fiscal perspective to kind of make policy with variable demographics across that block, which is kind of an important part of this whole debacle. And so now, with Putin and his escalation and military escalation into Ukraine, what's essentially happened is that the Western countries are sanctioning Russia, and Russia's sanctioning them back, and basically calling their bluff in energy terms. So now Europe has a massive energy deficit, and the surge in prices is allowing them, or forcing them rather, to go into other global markets, whether that's from the U.S. or buying a lot of this energy and gas, oil and gas, back from a higher price from China, who's simply just buying it from Russia. It's quite absurd, honestly, but in somewhat a virtue signaling manner. But this essentially, estimates now are coming in for the rest of 2022. Over the next year, this is going to have a 15%. The energy surge is going to cost Europe 15% of its GDP. And so, if you know anything about modern credit-based economies, especially in this debt environment for fiat currencies, this surge in inflation and reversal of 20, 30 years of disinflationary conditions built upon globalization and kind of a unipolar world order where everybody was harmonizing in unison. That's a maybe not completely different today, but it's all reversing quite rapidly, and kind of the lines are being drawn geopolitically. China, Russia, the United States, Taiwan, all these players in the back that are kind of implementing protectionist trade policies and restocking their military. There's obviously a clear escalation point coming, and none of it over the short to intermediate term is good for risk assets, because you have yields soaring in bond markets. Bonds are selling off, the biggest market in the world. Stocks are selling off in tandem because of an earnings recession, and at the same time you have again Europe and the UK coming in and trying to paper it over with more stimulus and more spending, while yields are screaming higher. It's ultimately going to lead to, over the long term, the complete meltdown of all fiat currencies in real terms, and the dollar will kind of be that last domino. But over the short term, it's a really scary situation for everyone in Europe. It's going to be very costly, and I think it's it's probably going to get a little bit worse before we can start to work on solutions and it gets better. Kind of a long answer there.
No, it was excellent though, and I'm curious too, like to couple this story with another story that I think relates. We're seeing now, as of yesterday and last week, Iran, yesterday, Russia announced that they're going to accept cryptocurrencies, Bitcoin being the main one that both countries have already started to use as a form of international trade settlement. Both countries are famously under sanctions, can't really transact with US dollars. Um, do you think that how important or how significant is something like that? Like, do you think it's in the realm of possibilities for a European country to step away from the sort of European central bank and say, we will pay you in Bitcoin, we'll pay you in rupees because like our citizens need warmth, our citizens need gas, or is your expectations based on what you've learned about the European Central Bank and the Eurozone, there won't really be a break or a change from them only wanting to stick to the petrodollar system?
Yeah, I think it's important to just recognize that this is all kind of devolving from just a unipolar world order, a dollar standard, right? Global energy trade has been conducted in dollars for the last 50 years, and really going back to Bretton Woods, 1944, where that dollar became that world settlement unit. And so the fact that Russia's even saying, pay me in rubles or maybe euros, which will convert into gold or other kind of base assets. Like Putin has said this over the last decade. He says, the U.S. basically robs the world by exporting its inflation, exporting its dollars. The dollar's artificially strong, and people that produce real goods, real stuff, get screwed over. And by people, I mean sovereigns like Russia, commodity exporters. Russia's the biggest commodity exporter in the world. So what do you do as an energy exporter or a commodities exporter? You're sending goods and services to the rest of the world. Well, that means you have a surplus, an economic surplus. And traditionally, if say the world is on a gold standard, and we never saw a globalized world, at an international economy at today's scale, or even 50 years back on a total gold standard. So that would, and it's because gold's very hard to move right across space. But going back to that, you have to store your economic surplus in something. And for the last 70 years, but really the last, the golden years of globalization, say 1990 to today, or maybe 2015, or whatever that peak was, maybe COVID. That economic surplus was stored in G7 liabilities. And what I mean by that, it's basically the sovereign reserves, sovereign debt of Eurozone countries, Germany, the United States, Treasury market being obviously the largest. You were holding your claims in sovereign G7, debt, right? It's an IOU and it's a promise of future repayment. But what's that payment worth in a world where right now we see the Bank of Japan saying we're going to buy any 10-year bond over 2.5%. We're going to buy it. So as rates go up, as the bond prices go down, we're just going to buy it and basically print more bank reserves. We're just going to suppress the cost of debt. And so that's what they're doing. They're doing that already. The ECB is hawkish apparently, because they're moving yields from 0% today to probably 75 basis points in the next, I think, month or so. Maybe it's this week. I should know this, but they just barely raised rates from negative, right? So, and they're basically walking into a sovereign debt crisis because all these governments, their citizens are going to revolt. It's already starting. You're seeing social unrest and quells everywhere already, and the people and the populace, the people think it's the politicians, in the same way that us watching in the U.S. Let's go, Brandon, like whatever your thoughts are on local domestic politics. But people go to the pump, people go to the grocery store, and they're mad at someone, and they're mad at the person whose supposed responsibility it is, and that's the incumbent political party. So both sides on the right and the left, the politicians, like this is the same thing we've seen in previous kind of 80-year cycles of history. When the previous two world wars, specifically like in the 30s, when you saw all of the kind of the fascist leaders arise around the world. Well, there was a reason that all those leaders became politically palatable, right? It was the Overton window shifted, and the populace demanded radical change in the form of whatever government, right or left. And so they're not going to people aren't going to sit around and as they starve or freeze this winter in Europe in a particular country. And that's obviously a little hyperbolic, but at the margin, if price is 5x, which they have, then the inputs of so many things in CPI, year over year inflation in Europe might hit 10, 12, 15, hell, even 20%. You're seeing German PPI at 30%. These things aren't politically palatable, and it's gonna lead to a lot of political promises and basically more debt to be issued by the ECB and those sovereigns, or not by the ECB, by those local sovereign governments. And so that's going to be in a debt market that's already selling off because of huge inflation, and it's going to force the ECB to come in and backstop the whole thing again. Particularly, you're seeing those four the pigs in Portugal, Italy, Greece, and Spain are already so weak and up to their eyeballs in debt that there's almost no option other than to kind of continue to just implement financial monetary repression and be a buyer. Essentially, it's yield curve control, but they're doing it across 15 countries, which makes it all the more challenging. So, I mean, it's a really bad situation. It's one of the, I'm a student of markets, and I haven't sat in the chair for a long time, but this is a lot of smart people that I follow and I respect, and I read their work. Are saying this is one of the worst situations we've ever seen. So it's certainly going to be an interesting 6 to 12 months.
Before people tell me I'm muted, I needed to make sure I wasn't. I love that you're drawing from history to sort of help you better understand and see what's going on here. Are there other clues from how we went from that transitionary period after World War II that are some warning signs, some cautionary things to be concerned about if they were to pop up present day in whatever form variation that would look like in 2022 or so on?
So to be honest, I was just looking at something I spaced out for the first half of the question, but I think if you want to repeat it again, just shortly, that help.
More or less, are there other things historically that are like, hey, that would be a really bad thing? Like this would be terrible if this happened in 2022, or if something similar in this vein that happened historically happened again. What are those type of events that you're concerned about?
Global energy crisis, we've seen debt bubbles, we've seen whether that's housing or subprime or tech or venture capital, and I've referred to 2021 as the everything bubble, since the start of 2021, and going into it when the central banks went crazy post COVID, Bitcoin included, right? It was obviously included in that basket of everything just melting up as a result of free money. And so now we're seeing this kind of unwind, and we're seeing a check on that everything bubble of this, basically hyperinflated asset bubble from stocks to bonds, right? You had bond yields below 1% at one point in the United States, the cost of capital for the world, right? On a 30-year basis, like it was peak madness, and it was certainly kind of illogical from a credit market perspective. And so as that bond bubble has deflated, right, what you're seeing is everything else. The most liquid market in the world is selling off. It's puking trillions up a day. So when Bitcoin is 800 billion, right, it's like it's just too small at this point to decouple from just the magnitude and the size of these things that are coming down the pipe. And that's fine. Like that's all the opportunity in the world for the sat stackers today. But from a financial system perspective, you certainly saw all of that kind of hidden leverage in the Bitcoin market. We knew about the kind of transparent leverage for a while, and we talk about it on Bitcoin Magazine Pro all the time. We talk about the perpetual swap markets and the funding rates, and these are essentially like it's native cost of capital in Bitcoin terms, demand for leverage, demand for debt, right? It's like that's the rise of DeFi. You kind of saw like this variable crypto native interest rate for both yields and borrowing, for lending and borrowing, and that was the same thing in the transparent Bitcoin futures markets. Is that you saw this variable interest rate to be long or short, and that interest rate for the perpetual futures contract ties its price to the actual spot trading price. You're trading $1 of fiat for $1 of Bitcoin, or right. That's happening every 1,000 times a second, obviously more than that. But the futures market, there's quarterly futures. So for say December of 2023, I don't think there's a contract for that. There isn't. But for December 2022, there's Bitcoin futures. And there's a price. And right now, it's actually probably a little bit below today's spot price. People are hedging out risk. But we saw all of that transparent leverage all get flushed for the most part. And to kind of back to neutral territory. But what we didn't know was the Celsius, the three eras capital of the world, that hidden leverage also all got purged for the most part. Now we're seeing really the stressors on the mining industry. We saw Poolin yesterday. They were, Poolin was essentially assuming the risk of their pool, and mining is all probabilistic, and it's ultimately luck. You're just flipping the coin, and then, but it's not really flipping a coin. It's obviously hashing a block. But I think they were assuming that risk, and it looks like they're insolvent. And they say they're not, but that's what every insolvent company ever says when they say, decide to pause withdrawals for, liquidity purposes. So you're seeing Poolin, you're seeing other kind of miners, right? Where I think about another at 17K will be at the lowest hash price ever. So hash price is miner revenue divided by hash rate. What does that mean? It means miners' margins are continuing to squeeze. So we're going to see more selling pressure from miners during this. It's a natural cleansing of everything, right? But risk is selling off around the world, and credit risk is rapidly becoming real in legacy markets. Volatility is picking up, and so we're gonna we've seen it in kind of bursts in 2022, but we're probably headed for some global margin call type moment. And in that scenario, Bitcoin is just, it's just not going to get bid. It's not going to decouple just yet. Like we're not in that world. It's okay to recognize it. It's much more volatile, and it's tied to global risk flows. And Bitcoin would decouple if there was meaningful, huge spot buyers coming in, new money coming in. For the most part, money is not coming in this ecosystem at the moment, and that's fine. I mean, I understand plebs are stacking. I even stack just a little bit, passively on the hour, but it's not a material part of my income. I'm actually just keeping getting a growing cash hoard to buy blood here. It's more of just kind of a tribute, stacking a little bit of sats every day. But the reality is there's no one is coming in with huge, massive size. I know the BlackRock thing happened and was announced at the local top this summer. But I think no one's coming in with huge size during this. No rich European or even the United States at this point, when equity markets are selling off, bond markets are selling off, volatility spiking, dollars, like the foreign currencies are crashing against the dollar, basically every single one of them. No one's going to be stepping in with huge size and buying Bitcoin, right? So like that's the reason to be like short-term bearish. And if you're long-term bullish on Bitcoin, that's great because your dollars, like there's a decent chance, it's a non-zero chance that your dollars could still appreciate in Bitcoin terms 50% from here, 100% from here. Like those are not 100%, but if Bitcoin's price goes down by 50%, you can buy twice as much of it. And so like these are things that could definitely happen. If Bitcoin falls 25%, you get 50% more Bitcoin. And so like I think it's just it's okay to recognize that as a long-term convicted Bitcoiner. Like Bitcoin is not a risk-off asset just yet. It's just not. And so that's okay. If things are going to get, like no one's in Europe's going to be buying Bitcoin when there's, they can't afford to heat their house. That's okay. But what's important to contextualize with all of this and why we even talk about, foreign currencies and bonds. We're a Bitcoin newsletter. Why the hell are we talking about bonds and volatility and all this legacy finance stuff? Well, I mean, we just like to quantify the monetization process of this thing. And it's still in the phase where it can, I mean, the market's telling us that. It's still in the phase where it can go down 80, 85%, 90% from the highs, which a lot of people in 2020 and 2021, myself included for a bit, said, this time's different, hyper-Bitcoinization. Like I was wrong on the timing early in the spring of 2021. But we're just not in that world. And so when this thing unwinds, which it's unwinding, the whole global financial economic system, the response at the end of it is going to be just a massive, and I think really the Fed matters. The ECB and BOJ can print, but if the Fed's not accommodative, if the Fed isn't bailing out the global dollar shortage and the US government doesn't spray a bunch of funny money again, that's really monetary policy for the world. And so on the other side of that, it's going to be just, you know, it's they're gonna have to reinflate the whole bubble again. They're gonna have to print their eyeballs out. But until that moment comes, I think it's going to be tough for a lot of risk.
So there's something interesting that you said, and P, I'd love your guidance and perspective here because I will age Dylan and myself in saying that we haven't been around nearly as long through as many cycles as you have. And you kind of hear these stories of like, oh, like this bear market's different because you have more companies now still getting involved talking about Bitcoin. I'm still of the mindset of from 2018 to 2019, you didn't hear mainstream media like CNBC on a daily basis talk about Bitcoin, whereas now you do. And while Dylan, I was laughing so hard at the BlackRock coming in at the local top with their latest partnership with Coinbase. And like, I remember reading those stories about, I believe it was Fidelity in 2017. Like they released their market product at the local top at that moment in time. And then all of a sudden, like everything went down. They closed these offerings down though previously. In this iteration, we're actually seeing businesses want to try to stay here. So P, my question to you is like, does this feel different? Does the environment actually feel like we're setting ourselves up? Or is this another cycle where inevitably we're in a bear market? People aren't going to be going in. People aren't necessarily going to be investing in Bitcoin or the ecosystem pretty much until, as the old trading saying goes, like, what have you done for me recently? Like until Bitcoin starts going up for investors.
Yeah, I mean, it's a great question. We talked about this recently. It does feel like we're in a very different situation. In large part because of the larger macroeconomic environment. Everybody is really looking to figure out like, okay, where do I maintain my value in a way that um, that was not happening in the last bear market in Bitcoin. Um, I, you know, I think that as we talked about as well, Bitcoin is undeniable now. To what you were just saying, like BlackRock did, announce this partnership at the top. At the same time, there are new news stories every single day about major banks, major entities continuing to very publicly get involved in Bitcoin, and we just didn't see that, to my knowledge, as much in the last cycle. So I do think this is different. Um, I think that people are turning more and more to Bitcoin, even as we are in this very, uh, you know, uh, uh, dark looking global macroeconomic environment, because they're starting to understand the importance of it, even despite the recent declines in price. So the short version is I have no idea what the fuck's going to happen next. It does feel different than the previous cycles, because Bitcoin feels way more undeniable. People are still talking about it, and it'll be interesting to see how it continues to play out.
Dylan, let's talk
Oh,
domestically.
wait, I actually do have one question. Sorry, that's related to that.
Oh my God, P's a lot.
Normally, I just sort of sit quietly and absorb the considerable knowledge during these types of conversations. But um, how is the how does the on-chain environment look different than where we are in the cycle in the last cycle's bear market? Have you looked into that at all, Dylan? Like what is the on-chain data showing us?
Yeah. So we still talk about the on-chain side of things. I think just from like when we're talking about like a price prediction standpoint, I think it's still on a at the margin, prices decided at the margin. It's still Bitcoin and a lot of these supply metrics we look at, right? And we talk about this. Uh, supply held for 1 year. It's I think it's flirting still with highs. Maybe it's come down a bit. I haven't checked in the recent week. But it's like 60% of Bitcoin haven't moved in a year, right? But that, Bitcoin, the supply inelasticity of it, the absolute scarcity of it, and the hodler mentality is great in bull markets because it just takes just a small tap of money, right? And the supply and elasticity, right? Sellers are exhausted, right? After you puke the lows, after Bitcoin during 2020 goes from 10,000. Everybody's, it's moon season, lever long. The halving is coming up. You know what happens next. And then COVID happens, black swan, all this leverage completely unwinds, forced selling, capitulation. There were, Bitcoin and BitMEX drove the price down 55% in a day. And what happened after that was basically there was no sellers left. Obviously, there was the tailwind of a ton of money, but there was no sellers. So what we can see with on-chain, specifically with something like realized price, where we can see the average cost basis of every Bitcoin on the network. It went from about 4K in 2020. So the average Bitcoin on chain, the cost basis, the realized price, swapped hands at 4K. And that was basically, I think it got to $3,500 at the absolute top in 2017, December 14th or whatever it was, 2017. I think it was maybe the 18th, the 20K top briefly. The average Bitcoin had only traded hands at like $3,500. Over the next 3 years, despite Bitcoin drawing down 85%, chopping around, getting to 12K in the summer of 2019, the average cost basis only really rose to 4,000. And then COVID happened, it puked. But from there, a hot ball of money came in, tried to move the thing, and all the willing sellers were gone. And so you saw that average cost basis with all the money that was chucked at Bitcoin, it went from 4K to 24K at the top of I think it was like November of this year. At the absolute top, it just kept rising. Old coins were getting found in stashes, switched to new hands in the bull market. New money was coming in. Since then, we've seen a massive capitulation in price. Bitcoin's down 85%, and that cost basis, I believe off the top of my head, and I can actually look from 24. I think it's around $20,000. It was at 21, and it keeps going lower. As on the reverse side of things, you see during bull markets, realized price goes up, coins are changing hands at a profit. In a bear market, you see basically any 2021 at 19K, anyone in 2021, and really anyone in 2020 except for a week or so is underwater, right? So you're seeing realized price go down in a pretty meaningful way. Let me try to find this stat for you. Right now, the realized price is 21,500. So Bitcoin's at 9K, Bitcoin at 19K, and that realized price is coming down because there's some capitulation. So I think it still matters, and it still gives you a really solid framework. When Bitcoin's under its cost basis, it's like typically peak bear market, right? Throughout the past cycles, it's like a fantastic opportunity to buy. But from what Sam and I have done with our analysis, it can still drop 50% below that, right? It can still, and it's done that. I think it's dropped 40% below its average cost basis in the previous bear market. So the average cost basis was 4K, but it went to 3.5, right? So there was some pain. Right now it's 19. It can go a lot lower, but we're still seeing that on-chain kind of capitulation play out. I think we're going to see some minor capitulation on-chain play out. As you get that hash price, that miner revenue divided by hash rate, that miner profitability margin kind of estimate. It's just a solid metric to look at across all miners in the space. It just looks at hash rate as a whole. You're going to see some capitulation there. And so these are the things that we like to watch with on-chain. But I think at the margin, it's still going to trade basically, if you look at a 30-second chart at any point, it's going to trade relative to global risk, to equities, to bonds, to all these things as it's more intertwined.
I'm gonna shift it to domestic debt now, if I can be.
Absolutely, go for it.
Okay, cool. So we have a Fed meeting in about 2 weeks. I know, Dylan, we also touched on at the beginning. The ECB has their sort of rate hike meeting, I believe next week or this week. As the year's kind of winding down, we saw at the beginning of the year what the expectations were. We're starting to see how those very much are not going to be the case. Expectations including what all these different central banks thought inflation would be at, where they expected or thought that interest rates would be at, and we're starting to see their plans blow up before their very eyes. If you'll entertain me for a moment, I want to give you the right to make decisions as though you are Jerome Powell. What are you doing in 2 weeks at the Fed meeting?
I mean, I think the markets just told them they're going to hike. They have to hike. There's still a huge spread between and the domestic economy doesn't look that bad. I mean, U.S. consumers are still spending. The kind of the fall in energy prices recently has helped that, and I think relatively the U.S. consumer and economy is in way better shape compared to anyone as a whole. But it's still, I still think we're headed for a recession. We see a lot of things turn over, like starting to turn over, like housing. And you also see just the wealth effect. What the Fed actually runs a lot of their modeling on is the reason that they want to get asset prices down is because they know that it influences consumer behavior, it influences spending, it influences demand, consumer demand, and they want inflation down year over year, right? That's the politically most kind of prominent thing, is get inflation down domestically and really globally, but no one else really runs the monetary policy of the world like the Fed does. So, I mean, I would throw a big hike out there. It's not going to shock markets. I believe that 75 is priced in, 50 is priced in. I'm not even sure. I should know this. I look at Eurodollar futures, which is basically the rates market for this almost daily. But yeah, I mean, bonds are setting new lows today. Long dated bonds. So anybody that's been bullish bonds after the kind of the massacre that happened in June, is really, like, I mean, you can look at Bitcoin's chart over the last since say May. You can weekly candles. You can look at treasury bonds. You can look at equities, or you can inverse the dollar index and look at that. And they're all telling you the same story. Like, and so that's why, like, I just remain quite pessimistic and bearish on the price. It's like, it's just it's global bubble of assets, this huge pool of assets, which Bitcoin is just still a tiny little like pond over here. It's like a sideshow. That the main show is there's a hurricane, and so, like, your pond, even if it's a really good pond, it's just not going to be able to withstand. That's just a terrible analogy, by the way, but it's just so tiny. Yeah, like I think that's the story here.
I get where you're trying to take that analogy. Let's go the other way though. Rather than filling this pond up, the US just markets as a whole have had so much liquidity pumped into them pretty much since 2007, 2008. As we've seen pretty much over the last 15 years, anytime the Fed takes the liquidity out of the market responds justifiably with a nice little contraction heading down before inevitably the Fed does something to re-inject liquidity into the market. Um, Rather than speculate on whether or not Jerome Powell has the balls or the gumption to actually unwind 15 years of liquidity, some of which he isn't even at fault for or had no part in participating in, do you think it's realistic for like the US to try and unwind all of it? Do you even think that amount of pain that would cause, would like the citizens, would people actually tolerate that? Would people get so upset to watch a full unwind all the way down to decrease the amount of liquidity that the Fed and the government has put into the public markets for the last 15 years?
Well, I mean, they're going to crash. They're going to crash global markets. That's what they're telling you, and it's not politically palatable. And they're going to probably. My current thesis, like market wise, as a participant, is that they, something breaks, and so it forces them to step back in. And what I think that's the Euro debt markets by the looks of the energy crisis. And then what comes next is probably the treasury market, because you have this global dollar shortage playing out, as global economic activity and trade slows. The circulating supply of dollars slows with it. You have, I think, $15 trillion of global denominated debt offshore, and that's just the on balance sheet stuff. There's similar to how in the crypto Bitcoin markets, you could probably see like some transparent derivatives data and be like, hey, there's this amount of leverage, and it doesn't seem like it's all that bad. And then you come to find out that you have Three Arrows Capital that going and borrowing unsecured from everybody. You have this very opaque, that to kind of bridge the crypto analogy. The much bigger story here is you have this really, really opaque global debt based system particularly offshore, where corporates, sovereigns, all the like, clearinghouses are negotiating and settling and invoicing each other in dollars, dollar assets, dollar liabilities, promises to pay dollars. So when this whole thing slows down, what happens is anybody that has dollar denominated debt just gets absolutely pummeled, and so the dollar screams higher, and there's defaults and all this, and the defaults exacerbate the problem further, because what happens during a default is money supply is destroyed. When the bond market sells off, when yields go higher, that money's just disappearing. Like there was $1 trillion of people thought was wealth or assets, and lower the next, at the open, and it's not there anymore. Like it didn't go anywhere. It's just destroyed. And so that's kind of the realities of a credit-based system. And I think the Fed, and it's not really the fault of the Fed or the fault of Powell or really any specific actor, but rather just the kind of incentive structures of debt-based monetary systems, governments, the voting structure in a democracy, and just the reality of fiat currencies is that they're going to take it too far. It's probably something's going to break in a massive way. And probably the treasury market at some point it freezes or becomes a liquid, or yields spike when they should be dropping, or whatever it may be. They pivoted in 2019 before COVID, and they started expanding their balance sheet again because of a repo issue, right? And so banks are more well capitalized today, but it's not maybe a banking system issue, rather just kind of this global margin call as Europe gets mauled. It could be really anything. And again, like it's not my total expertise, but just being a student of history and analyzing previous debt cycles where there was far less debt in the system and interest rates were at a starting point much higher, something always breaks in a debt crisis, and it leads to more Fed easing, more central bank easing, and a real kind of devaluation of global currencies. I think where my kind of master thesis, the reason I honestly left college just to stack Bitcoin and to focus on Bitcoin as an asset before I even figured out, before I knew I was going to be working at Bitcoin Magazine, was that we're kind of at this end stage of a global debt bubble, global debt cycle, long-term debt cycle, and something's on the other side of it. And I don't think it's a new CBDC, and I don't think it's gold. And so, the optimist in me, the technologist in me says that's Bitcoin, from everything that I can see. And it's going to take some time. There's going to be a ton of volatility along the way, and with that, a bunch of opportunity. So I think that's the long-term vision of all this.
I don't think any of us would necessarily disagree on that long-term vision. I am curious though, and not in a speculative manner, just potential ways for Bitcoin to usurp the dollar in the midst of what is about to be the dollar milkshake theory playing out. We're seeing Japan slowly collapse. We're talking right now about the inevitable collapse of the euro. The dollar milkshake theory would dictate that because all these countries have debts denominated in USD, they will inevitably be forced to adopt the US dollar as their main form of currency. My question is, in this process, how or what are ways for Bitcoin to almost inject itself as the lifeboat for these different countries?
Yeah, it's tough. I think more kind of local adoption with like stuff with El Salvador, but just the reality is, that the dollar and the need for it at the moment is despite again the dollar falling in 10% in real purchasing power terms. There's so much demand for it because one, the largest economy in the world, the U.S., requires you to pay your taxes in it, legal tender laws, etc. But two, it's just there's so much dollar debt out there. So if you're indebted in the USD, you need to find a way to earn it, and you need to find a way to pay it, or else you as an entity, a corporate or a sovereign, are insolvent. And so I think because in a credit upswing, the upstart of a credit cycle, when there's kind of this reinforcement loop, positive reinforcement loop. Everybody's incomes are rising, assets are rising, debt's becoming cheaper, liquidity is improving, credit worthiness and conditions are easing. Dollars are abundant, and although the long term trend for dollars, is like this, or the purchasing power is like this, it's sloping downwards, that's obvious. There's a bunch of boom and busts along the way, and kind of with the domestic credit cycle and really the international credit cycle. And so I think we're in kind of one of those downswings where actually, somewhat paradoxically, when inflation is 10%, aside from being, I guess, short a lot of risk assets, short bonds, there's obviously those trades you can make. But what's the best place to be in when, globally, when inflation is 8, 9, 10%, 11%, 12%? Well, for a lot of people, and for most people, it's dollars, paradoxically, over the short term. Like, this is just, and for even a stacker, right? You can have 50% of your net worth in Bitcoin. I wouldn't say, and as someone who's had 100% of my net worth in Bitcoin for a good part of my entire adult life, since the day I started earning a paycheck, I started stacking Bitcoin. Like, it's okay to have dollars if you understand how a credit-based system works in the short term, and your purchasing power in real asset terms, whether that's shares of the S&P or oil producers, or you can measure it in units of gold or whatever. You can measure it in Bitcoin. Your purchasing power in dollar terms during these periods can actually increase by a lot. If like stocks have fallen 20% or 19% or whatever it is, they can fall another 20%. Like Bitcoin dropped another 80%, dropped 80% from the highs. Volatility, the way this thing trades, the relative lack of liquidity compared to other global assets, like it can fall another 50%. And so there is, despite the long-term asymmetry of Bitcoin, like that's undeniable. And I literally bet a lot of my life on that thesis. Over the short term, there could be a ton of, and I would argue by far, actually, by a wide margin, dollars over the, say, next 6 months, in BTC terms, in S&P 500 terms, and in really anything terms, maybe even real estate, like whatever, it could be global credit, dollars, the asymmetry is so strong over the short term. Like you watch the Bitcoin chart, and any bounce over the last, even when, a lot of the crypto ecosystem went up 100% off the lows. I get a lot of it's, scammy pump and dumps, but, ETH goes up 100%. S&P 500 goes up 20% or 25% off the lows. Bitcoin goes 43% off the lows, and it trades at 3x the historical volatility roughly, and 3x the implied volatility of equities. And it only bounced like not even double. And similarly, it's almost at its lows. And so it's like, yeah, I think there may be some short-term asymmetry in dollars. And the only reason I care is because on the other side of this thing, like the goal for me is to have as much Bitcoin as possible. Because I think that's, in a decade of eroding globalization, in the end of a debt super cycle, the reality is over the longer term, the populace will literally demand, and governments, politicians will abide, central bankers will abide, to print the currency into oblivion. And so I think that's the end game. And for Bitcoin, you have a digital synthetic commodity, a monetary asset you can send anywhere in the world that has a marginal production cost that's literally going straight up and to the right, with a ton of volatility. But the long-term trend, throw a moving average, you can't even calculate the marginal production cost because it's marginal. And so some people will produce it for zero input costs, whether it's waste gas or whatever it is, waterfall, hydro, right? It doesn't cost anything to produce water. It's abundant, energy abundant, and it's not located near where humans are desiring it. There's this incentive just all over the world, mop up excess energy with Bitcoin mining. And so basically the marginal production cost, because of Bitcoin supply schedule, because of the difficulty adjustment, as hash rate goes to the moon, and as Moore's law kicks in and the miners get more efficient and better, and hash rate keeps going up, you're going to see the marginal production cost of Bitcoin programmatically tick up with it, as issuance goes to zero, and again, difficulty keeps ratcheting up. So I think that's like the upside is that we have this thing that nobody understands that trades like a total risk asset. And if it's a digital synthetic commodity that it credibly enforces monetary policy in a world where central banks have gone mad, gold has been completely captured by paper markets. There's a reason it didn't succeed as money in global markets before. There's something potentially really big here. And that's where you can increase your purchasing power by a factor of 100 if the thesis is right over a 10, 15 year span. Yeah.
Beautifully said, Dylan. You almost reminded me, and I just wanted to get your like quick thoughts of uh, the dictator that runs this terrible now terrible once great state of California decided over the last 2 weeks to ban gas cars, and then shortly thereafter ask everyone in the midst of our first heat wave of the year to not plug in said electric vehicles. When you see policy moves like this, uh, just want to ask you: is California going to make it? Oh, you're muted.
I'm not gonna lie, I've never been to California, but probably not gonna make it. So,
You
good
heard it
luck
here
out
first,
there.
folks. California is fucked.
This is true. This is true. Well, Dylan, as we wrap up here, I wanted to give you the opportunity to touch on anything else that we haven't touched on. I know that you and the Bitcoin Magazine Pro team have put out countless articles touching on much of the stuff we've talked about here today, as well as so many other things that just go on in the world and how it all relates back to Bitcoin. So I want to just give you the opportunity to touch on anything else.
Yeah, I mean, I don't have too much more to add. If you're interested in any of the stuff I rambled on about today, make sure to check out BitcoinMagazinePro.com. It's Bitcoin Magazine Pro. You can find it in Substack if you already have the app. We've actually been getting a ton of native Substack recommendations lately, which is cool to see. It's there's a growing network of publishers and kind of content creators on Substack. It's a pretty cool thing. But we talk about it all. So there's visuals. We just recently brought it up to Jeff Ross, who's going to be putting out basically live positioning for anyone that, if you want to stack sats and chill and just take in content, that's great. And Sam and I are going to be pumping that out. For the more active crowd, Jeff Ross is going to be putting out a pretty cool product. So for anyone that wants to see that, we recommend you give it a go. And thanks for having me on. This was a fun talk.
Dylan, thank you as always for joining us. And I cannot stress enough, guys. Bitcoin Magazine Pro is easily the best macro newsletter out there. There is a free version. It costs you no money at all, and you're going to get a lot smarter from reading the analysis of guys like Dylan, Sam, and Jeff Ross. So be sure to go subscribe now. I'm going to call it. Let's just wrap.
My friends, thanks again. See you tomorrow.